So why would traders trade? That means why would they buy and sell versus write and sell? Now take note. So let me give a hypothetical example, right? So in the upcoming month, the first week of November, we are going to have this election between Joe Biden and Donald Trump. Everybody is, the whole world is watching. Now I'm not very sure who's going to win. But let's assume that you have some form of crystal ball. And the crystal ball can be some trading software, some candlestick, some indicator, whatever. You paid so much money, right? That based on your software, based on your experience, intuition, or whatever, you had this feeling, you have this intuition that the share price will go up. Yeah, go up. Whatever share price. The Barrick Gold, S&P 500, whatever. Yeah. So what can you do? Now, so if you are speculating, guessing that some stock price will go up, so what option traders will do? Now remember, right now we're talking about option traders. We are no longer talking about option sellers, which is us. So what option traders they will do is, if they make assumption that the share price of something will go up, right? What they will do is they will buy one kind of option called the call options. Now remember, there are two types of option. One is called a call option and one is called a put option. Yeah. And the reason why they will buy a call option, right, is because when a share price of whatever underlying derivatives, not derivatives, underlying equity goes up, right, the call premium will go up. So one more time. How call option premium works is when the share price of the underlying stock goes up, right, the call premium will go up. Okay. Now, so if the share price go down, the call premium will also go down. And because remember, they have the crystal ball, right? They have a crystal ball that this Barrick Gold, the share price will go up. So what will they do? Yeah, if they can see into the future that the share price of Barrick Gold will go up, what will they do? They will buy the call option, right, of Barrick Gold instead of buying the stock. But why? Why? Ready? Now, so their assumption is this. They buy a call option because they assume that this Barrick Gold or whatever stock will go up. Yeah, so that when the premium goes up, right, they quickly buy at the low price of this call option and sell at the high price of this call option before the option expire. So they can make the difference. They can make the spread. So let's look at a real life example how they do it. Okay. Remember, just now we are on the other side, right? We want to sell option. So now we take this divided by this, and then we have the 1.76, right? Yeah, but remember, right now you must imagine you're the speculator. You are no longer our graduate. If you attend some option trading course and the trainer told you you can buy call option, not sell. So what do you do? Now, so when you buy a call option, in this case, right? In this case, so let's say you buy call option, forecasting, guessing that the share price of this Barrick Gold will go up because you have a crystal ball. So what do? You buy one contract, right? You buy one contract is this 1.05, which is found here, multiplied by 100. Okay, so this is upfront cost. Upfront cost. So remember, you pay, right, because you bought something. So you have to cough out $105. Now to make money, the option trader will have to wait until the premium of this 0.97. Do you see there's a 0.97 here? Yeah, later on when the US stock market starts at 9:30, right, I will log inside my trading account and you will notice that this 0.97 will start to fluctuate, and it will correspond to the share price of the Barrick Gold. So later on, if the share price of Barrick Gold start rising, right, this 0.97, right, will suddenly become 0.98, 0.99, and so on. Yeah, share price goes up. Yeah, share price goes up, the call premium will go up. So if you're option trader, you have to wait. You have to wait. Either you stare at the screen or maybe next day or a couple of days, you keep on monitoring your share price. So when the share price go up, this 0.97 will start to rise. 0.9, 0.99, you hit 1, 1.01, 1.02. Remember, even when it rises and hits 1.05, you're just breaking even. You're not making money yet. Okay? Oh, by the way, can someone stop doing the graffiti, right? So let me see whether I can clear the graffiti. Thank you. Yeah. So remember, this 0.97 had to continue rise as the share price rise until it hit 1.05. Yeah. But before it hit 1.05, anytime you sell, you lose money because there's a spread. So you wait until it rise, and then you wait until it cross 1.05. Yeah, then you start to make money. But remember, you still have to pay for the commission. Okay? But let's assume that you have a crystal ball and eventually the share price shoot up. Yep. So how much can you make, right? How much can you make? Okay, ready? Bear in mind that as the days go by, the option premium will decrease over time because it's getting closer and closer to the expiration Friday. Yep. Now, so this is buying a short-term call because here Do you realize that here is 33 days? 33 days, huh? But some people, right, they are teaching others that say, hey, you can actually become a value investor, right, by buying a long-term call option. But remember, Warren Buffett do not buy option whether it's short-term or long-term. Hi, this is Cayden. Remember to click on the subscribe button and turn on the notification to be notified of our future training videos. So buying short-term, long-term is not value investing. Yeah, but they may disguise it as so. So when you buy a long-term call option, what do you mean? You can see here, right, instead of 30 days, right, 30 plus days, I choose a 2, 3, 6 days. So you realize that the premium is no longer than 1.04, but it's 2.91 because right now I'm buying a longer option. So if I buy a longer expiration date, I have to pay more, right? I have to pay more. I have to pay the VIA seller more, right? So I pay 2.91. Now, so what do? I buy call option, upfront cost is this 2.91, multiply by 100, right? Because I bought one contract, this is my upfront cost. And then to make money, remember, I have to wait for this 2.80 to rise, 2.81, 2.82, 2.83, until 2.91, break even. And then when I cross 2.91, then I make money. Yep. Okay, bear in mind that option premium decreases over time. So just now I give an illustration about if you buy a short-term call, which is 1 month, you pay little, you pay lesser. But if you buy a long-term call, you have to pay more, right? Because there's a longer expiration date. Now, so do note that all options have an expiration date, and if the option trader did not manage to sell their options before the option expires, they will lose 100% of their capital. Yeah. Let me show you how it works. Okay, now, so in other words, this is the risk. Because when they buy a piece of paper, there's a countdown timer. It's like a ticking time bomb. Tick. Even though it's 200 plus over days, but this 200 plus over days is counting down. 200, 199, 198, tick, it's counting down, right? So you are already holding to an option which is expiring day after day. Now, if you don't toss it to someone, if you buy and you didn't manage to sell it to someone, and this option self-detonate, you're going to lose 100% of your capital. Yep. So now the key thing is, then why would someone risk 100% of the capital to be an option trader when they can choose to be an option seller, right? Now, there must be some reason. Now, but why? Take note. Now, if you look at this case, remember, their capital outlay, right, is 291. Now, remember, this is paid. This is already paid already. This one is not paid yet. This is just standby. Now, so what are the key reasons why option traders want to be option trader, right? Because someone told them that in order for them to become very wealthy, to have a high ROI, your capital outlay is lesser than option sellers, which appears to be true because 291 appears to be less than 2450, right? Yeah, bearing in mind that this 291 is already paid, but 2450 is just standby. Okay, but it's okay. Let's assume that this 2450 is being paid. So this amount is really smaller than 250. So that's one reason why option traders want to be option trader as compared to option seller. Now, but the other one that's most tempting, right, is the ROI. So take note, why option trader want to be option trader? Ready? Now, if the share price, remember they bought this call option, right? Yeah, and the share price has to go up. If the share price go up, this 2.8, right, will slowly go up until it hits 2.91 and then you will cross. So let's assume that you guessed correctly, and the share price did cross this 2.91. Yeah. And then suddenly the call premium jumped to 3.6. Okay. So what will be the ROI? This is just a hypothetical example, right? So the ROI is, you bought a 2.91 right now, you rise to 3.6, right? So this minus this divided by the original cost, right? What's your ROI? It's 23.71%. Do you see why option traders want to be option trader? It's because when a premium rise past this break-even point, right, which is 2.91, suddenly the ROI will become very big. Yeah. So these are two key reasons why option trader want to be option trader, because it gives people the impression that one night they can make 23.17%. Okay. If you look at this, So in other words, if you hear someone say that, hey, You know, why do you want to learn option selling and then you collect 1% while you can make 23%? Now, you have to be very careful is because in any investment, we have to look at the risk and the reward. But our only concern that some people, they cover the risk. They exaggerated the reward. How do they exaggerate? They say you can make a lot of money, which is high percentage, using little money, which is true. But they tell only half the story because this is the risk and this is the reward. Okay? Now remember, there's no right or wrong. I'm just sharing with you the numbers, and then ultimately as an intelligent investor, you decide what you want to do. Yep. Now, so the next logic is quite easy. Now, if your capital outlay is 291, and then you make 23%, right? And you win for the first time. Let's say you guess correctly for the first time. What will you do? You will not stop, right? Because to you, alamak, option trading is so easy, right? You just buy a straight call, whether short term or long term, you just buy, and then if the share price go up, you make money, right? Yeah, so first time you put 291, you make 23%, you feel very shocked. Second time you put 291, yeah, you make another 23%, so you feel very shocked. So let's say you do this consecutively, 10 times, and 10 times you make 23%. Out of 291, not 2.9 million, right? It's $291. Wow, you feel very shocked. And the moment that you do this 10 times, you felt that's very sure. It's like you buy a lottery ticket, right? You use $1. You go to Singapore Pools, you use $1. Oh, $1 you make 120, 20%. Wow, you feel shocked. So second time you use another dollar. So you make 120, you feel very shocked. So you do this 10 times. After you do it 10 times, what is your conclusion? Your conclusion is, if $1 I can make 20%, why should I put $1, right? Shouldn't I try out, like, let's say 10,000, yeah, or 100,000? Because $1, I mean, how can I be rich, right? Yeah, but remember, when you enter Singapore Pools and you buy the lottery ticket for $1, the feeling, right, is very different as compared to you sell your entire house, your maybe 5-room or condo, right? You sell, you get 1 million cash. And you take $1 million, you walk in Singapore Pools, and you use this $1 million to buy one lottery ticket. Yeah, do you see the difference? Yeah. So in other words, speculating, it seems quite fun, it seems quite shock, but it's not scalable because the feeling is different. The feeling is different. And be very careful, right? When you make 23%, when somebody say, hey, Cayden, do you know I make money out of options tonight, 20%. I mean, the key thing is, yeah, 20%, but how much? Do you spend $1? Do you spend $10? Or do you spend 100,000? It's very easy to boast in terms of percentage. You must always hear what is the capital outlay. Yep. So I put the $1 million note is for you to appreciate that if you have $1 million, and this is what you have, you borrow from a wife, whatever, this is all you have, $1 million. Would you dare to put $1 million and buy a straight call, whether is it short term or a long term call? Yeah, I mean, whatever answer you have, yeah, will give you the feeling, right? What path are you taking? Are you taking an investing path, or are you taking a gambling path? Okay, so this is why I let you decide. Now, so just now I've said, right, you will make 23% up to 91 for the very first time. What will you do? You'll continue to do until the cows come home, and then slowly you increase your stake, and you will only stop until you have lost all the money.